Welcome to TheoTRADE. This is Don Kaufman. It's April 17th, 2025. 45 minutes go to the cash close here on this Thursday afternoon, but it's really kind of synthetic Friday because obviously we are going into a holiday weekend. Markets will be closed, of course, for Good Friday. That is tomorrow, April 18th, headed into, again, the Easter holiday weekend. Oh, I got to tell you, this week almost kind of needed this, right? The markets they kind of paused. A calm fell over the marketplace. I'm just going to tell you, though, right up front here, volatility is far from dead. It's far from dead. The exact same issues are persistent, if not larger than they were last week. And I'm talking about structural issues. Push aside all the tariffs and everything. Sick of the tariff talk. Look, one of the first things I want to point out here on this TheoTRADE weekend update, I want to jump right to the spiders and reiterate the point, okay? The S&Ps were in a downtrend before we had, any liberation day of any kind. Like, look, right? If markets, saw this coming, sure, they were seeing some sell-side activity here. No, markets did not see the tariffs coming at all. It was a dramatic misprice and obviously had a precipitous drop. Okay, nevertheless, we were in a downtrend prior to that. So what does that mean for right now? Look, as I said to you guys, things kind of calmed down this week, but there are some significant kind of structural issues to the marketplace, and that it has nothing to do, look, I know that people want to hear about a MACD and a Fibonacci and a Bollinger Band. You're just not going to get that, okay? Because you're in volatility right now. And just because it calms down for a couple of days, okay, it clearly has not resolved itself. And one of the first things I want to do is point out some of the issues that I presently see in the marketplace before actually talking about, feelings about, hey, this is what we're looking for, next week. This is what we're looking for the next couple of weeks. So let's get to it. One of the first things I'll cover is, in the S&Ps. So the S&Ps here with, again, 40 minutes to go, they're up 13. To me, that's the least important thing on the screen. Well, why is that the least important thing? You may or may not realize, but this week, you had a 250 point expected move. The S&Ps are looking for a 250 point move up, 250 point down. Actual move is nominal. But the reason I say the S&Ps, they're massively unchanged in the trading session. That's the least important thing on the screen, because when you're looking for a 250 point move and you get absolutely nothing, okay, you got to be careful what you say, because it might be nothing right now. In the next 40 minutes, this thing could get absolutely wild. At any point, when you are still, projecting volatility in a given week, at any point, that could actually catch fire, light this market up in 2 seconds. And you got to be careful of that. Okay, so the reason I'm getting into that, now I typically save expected move for the very end of each of these weekend updates, but I think you got to cover it right now, right up front, because the expected move, again, that we're coming out of, is 250 points. But if you start to look forward already to next week, okay, you still have over $150, $160 expected move. Now, obviously, that's not settled. That could, go up or down a little bit. So bottom line is, even though that some people okay, things kind of mellowed out a little bit, well, the expected move went from 250 points to 150, but even 150 is still pretty considerable for any given marketplace. And again, I'll remind you right at the end of this video of that expected move. So as I was saying, overall, a calm kind of fell over the marketplace. And then volatility, though, it's down. So we'll start with VIX. Okay, volatility is down, but it's definitely not out. I mean, again, I'm not a big advocate of VIX, but VIX is still in the 30 region, and VIX in the 30 region, that's still put on your big boy pants. That's the only way to really describe it. Okay, if the marketplace was all clear, you would see volatility completely and utterly collapse. And this is On the contrary, it's not collapsing down. And again, the reason I don't use VIX, VIX is a great just overall explanation, right? Like, hey, the VIX is still in the 30 handle. Okay, crap's real out there. That's easy enough to say. But the one that I really like looking at are the volatility futures, because the volatility futures, okay, and I'm actually going to freeze the screen right now and just display this. I want you to look with me at May, June, July. And look how big the backwardation. It's still a full point, meaning that May is at 27 and June is at 26. Now, listen, there are people that are tuning in for the very first time. They have no idea what a volatility futures contract even is. That's okay. What I'm trying to say, okay, and I'll be very, very clear about this. May contract says that risk in the time frame of 34 days is still considerably larger than the time frame of 62 days. Now, if you start thinking about that, like constructively, like thinking about it, be like, wait a second, you have 34 days and risk is extreme, and then you have 62 days and then risk is actually less. How could there be less risk with more time? Like, even if you go out like 90 days, this like, it blows your mind to like think about this. Risk right now is at 27, but 125 days from now, it drops to 24. Basically, it's why they call it backwardation, okay? It's as backward as it sounds. Risk is so extreme in the market right now, okay, that the next 34 days, the world is more likely to blow up in the next 34 days than it is in the next 90 days. And that's a wild concept because that's basically the signature that you look for to scream. Like as a trader, you're like, game on. And that game on signature is still there. You know, until we uninvert what we actually talk about with going back to what's termed a contango. Okay, there's contango and there's backwardation. Contango is actually when the May would drop below the June. This crap, okay, is so important because, as I said, like, you know, you want that MACD and a Fibonacci and a Bollinger Band out of me, you're not going to get it. What you're going to get out of me is I'm showing you, okay, that the marketplace is still screaming game on. It's absolutely screaming game on. Moreover, the VVIX, the volatility, okay, of volatility itself is still relatively high. Anything above 110, okay, and that's, you know, I always say you get under your desk, start rocking back and forth, and we're almost a 120 VVIX. And yes, it's come down, but it's interesting to see like this week, this has been a 4-day trading week. It dropped initially and then just kind of held its own. As I said, like it's a strange pause. We've only paused, okay? Somebody hit the pause button, but that volatility, and sadly, it's going to make a big comeback. Just don't get your head taken off. Like, you know, keep yourself ready for it. All right, the next point that I gotta make over here, liquidity issues are still really persistent. There isn't any. There's just no easy way to say this, but I'm actually going to cruise right into the S&Ps. I'm going to show you what I mean by like liquidity issues and there isn't any. Okay, ready? Freeze the screen. So, and I'm just going to show you. We're looking right now at what's termed an active trader ladder. And I'm just, you know, freezing the screen at any point in time. And we have a bid size and an offer size. Now, yes, we're looking at an S&P futures contract. And this is where the contract's trading. And you can see there's 4 contracts on the offer, okay? And, you know, a handful on the bid. Just time out. And again, I'll freeze the screen again. Here's, you know, 10 on the bid, 11 on the offer. Those numbers are usually, okay, you know, at least 50 deep on either side. And what this is indicative of, there's no liquidity to absorb a move. So if a fast move comes to the marketplace, okay, the top of book is very, very thin. And when we talk about with top of book, and people have heard these terminology before, but they have no idea what the hell we're talking about. Okay, this is actually looking at depth in the marketplace and saying like, look, there's only 3 contracts on the offer right now. That's ridiculous because what's going to happen is if we trade this level, there's only 3 being offered at that level. So if you wanted to do like 100 contracts at that level, okay, there's no liquidity to absorb your move. So what happens, they do 3 here, 20 here, 30 here, okay, and all of a sudden price just boom, it explodes, or price boom, it drops like a rock because there's no liquidity to support it. With the liquidity issues are persistent this week. Liquidity providers, they don't want to step up into this. Scared. They should be scared. They don't know when the next tweet or Truth Social thing is coming out. So we got some issues. And again, not to get political, but whether you like it or not, there's going to be liquidity issues as long as the administration keeps tweeting at us. Okay, it's going to make this marketplace place skittish, and it will remain this way until that actually kind of dies down. There is a threat every single day to the marketplace to get tweeted at. And market making firms, like, look, they're fast. They're trading, obviously sub-second, and they're quoting in billions of a second. They're not fast enough against a tweet. That tweet comes out, those market making firms, okay, they don't want to provide, like 100 contracts on either side of the marketplace, because if we do make a fast move, they're going to be absorbing huge amounts of liquidity, okay, at an incredibly fast moving pace. Nobody wants to take the other side of that. So what do? The markets are thin. Now, with the markets being thin, as I said, like almost like an eerie kind of calm falls over the marketplace. The other thing I really want to point out, okay, there's no volume right now, none. Liquidity differs dramatically from volume. Last week, there was no liquidity, but there's a crap load of volume. This week, okay, there's no volume. It's no volume. Like, look, pretty big day yesterday. Yesterday was, Thursday. S&P's at one point down 100 and plus, and we didn't even do 2 million S&P contracts. We didn't even do 1.5 million S&P contracts today. Okay, it's abysmal. There's no volume right now, and you can start looking at like other products. It's the exact same thing. Okay, the volume. People are like, oh no, it normalized. What are you saying? It normalized. There's a $250 expected move this week, and the volume is just gone. There's no commitment to want to trade right now. That unto itself makes me a little nervous for some of the price action coming up. When volume's gone like this, is people are waiting a little bit to position themselves. It's not about earnings at this point. They're looking for more information. So every tweet, every little news announcement, for instance, you better be intimately comfortable with your calendar. Like, you better know next week, okay, what's coming out. And I always detail this, like late next week. It's ridiculous. Consumer sentiment survey. That's going to move markets huge. I'm serious. It's going to move markets huge. There's not any, massive data per se coming out, but even stuff like PMI, it's going to move markets huge next week. You got to have your game face on, because every little nuance is going to move this marketplace. It's skittish. There's no liquidity. Okay. And everybody is waiting to position themselves into it. So the volume is absolutely gone, along with liquidity issues that have been very, very persistent. Now, bond markets, also a bit of a cause for concern. Watch this, okay, in the backdrop next week. If early next week you hit Monday, Tuesday, even if there's a little bit more sell side activity taking us down to like this 112 region inside of the bonds, okay, you're in trouble at that point. Okay, bonds could actually be the next trigger for the S&Ps to actually rage a little bit. But quietly in the backdrop this week, the bond market had a little bit of a bid back, but it's actually giving back almost a full point right now. And once again, the thing that also makes me nervous here is the bond volume. Okay, it's abysmal. It's non-existent. You went from some of the biggest bond volume on record, okay, to completely and totally disappeared. Very, very nerve-wracking, because you're not getting a clean picture, in my opinion, of price, okay, until you have better liquidity, better, depth of marketplace, okay, and people trade. And right now, as I said, it's kind of calm out there, but I think that trade is holding back. I mean, they really are holding back at this point, because there's just nothing going on. This does not have to do, no one cares going into a holiday weekend when there's volatility like this. Everybody's waiting kind of for the next shoe to drop. All right, onward. Let's talk for briefly about like NVIDIA and just tech in general. Okay, I got some strong feelings on this. NVIDIA is back in a downtrend, and I've said this time and time and time again. NVIDIA is down 26% year-to-date basis. Obviously, Meta is down about 16% year-to-date basis. And the reason I want you guys to see this is tech does not look good. It does not look good. So if there's something that obviously has led this marketplace to the downside, it's been technology. And I reiterate, technically speaking, it does not look good. Even though Apple has got a little bit of a bid back under it, okay? It's this really broken, very disconnected looking chart. Okay, Apple's the only one that you'd be like, oh, it had a nice bounce over here. It's the only one that really looks decent. Like, look at Microsoft back in a downtrend. Amazon, horrendous downtrend. Okay, Google, okay, back in the downtrend. Meta, I just showed you, is at the lower edge of the downtrend. Tesla, okay, Tesla's just been moderating, waiting for its earnings announcement. Boy, that one's going to be interesting. And obviously, Nvidia back in the downtrend over here. I'll even go into Broadcom, which is dropping back, okay, to some degree throughout this. I do not have anything positive to say necessarily about tech, but again, I kind of key into Nvidia. This is going to be the one to watch, obviously, early in the week. If you see more sell side in Nvidia, the marketplace cannot substantiate gains. That is, the S&Ps are not going to substantiate gains unless tech is on it, which actually brings me exactly to my next point is, you know, if you're looking at the markets right now, you're like, what are you talking about? They kind of held up a little bit this week. Like, if you look at the markets, and again, I cruise back over to the SPX, you look at the market and you're like, the market's down nominally this week. Okay, actually, take a look at the QQQ. The QQQ, and let me apply auto expected moves because the Qs actually hit the lower edge of their expected move and they bounced. The Qs are more than halfway home to the lower edge of the expected move. It was not a good week for NASDAQ. You go, then how come the S&Ps held up so well, Don? Okay, and I've got an exact answer for that. It's energy with a little bit of financials. Okay, that's what it really comes down to. You realize that energy is up some 3% today. Look at the bid back. Now, granted, energy, it got decimated 2 weeks ago. I mean, it was ugly. Okay, this to me is just a bid back right now. I think energy is going to get faded again. In fact, I'm going to be in a short energy position looking for it to fade. There's just no question. This is the preeminent setup. I love this, like big sell side activity. Okay, the rip, the fade, the rip. We hit the upper edge of the expected move. If I had more time today, I would fade this today. But I'm going to try to actually fade it coming into Monday, meaning that I'm take a short position in here, probably some type of an in-out spread. Maybe not in XLE. I'm going to look, obviously, ExxonMobil, like Chevron, but those are going to be passing through earnings. So I might be forced to use the ETF product over here. What do I care? As long as I can have degrees of profitability, it does not matter. But this is one of the reasons the marketplace is actually holding it together, along with some of the financials. The financials, okay, they had earnings. They've got a bid back, but they substantiated big gains last week and kind of holding their own this week. But the financials, you know, basically recovered. This is where you're like, you know, 50% plus from from some of those recent lows in here. Okay, but again, I think that this is a little bit more disconcerting. Okay, I'm not saying you need to, you know, go out there and short some tech stocks. Okay, no, I would actually look much more at the financials and much more the energy sector. That this bounce, okay, may not hold. It's going to be opportunistic in the very near future. Okay, so very, very important for us to get a good feel for that in the right here in this near future of at least where I am looking. Okay, to kind of position myself in kind of the next couple of days, both financials. And by the way, we're through most of the financials earnings. Okay, you see some of the bid back here to Goldman Sachs. Obviously, a little bit of a bid back to JP Morgan. It's a bigger big back to JP Morgan, but we're going to take advantage of that in the coming days. All right. So once again, last but definitely not least, we jump back to the SPX. As I was saying, and again, I just want to kind of delineate exactly what the expected move happened to be through the course of this week, because it is shocking. This week, you literally had like a $250 expected move. I mean, the marketplace was like, oh, it's expecting Mr. Toad's wild ride. So what happened this week? We did see elements of volatility pick up on Wednesday. There's no question. The S&P sold off, but there was no volume behind it. There was no, like, you know, you got a punch to the trade, and there wasn't there. Okay, the liquidity just simply was not there. So with that being said, okay, to see us actually collapse the expected move into next week is of no surprise. It's going to be right around $150 when this market closes. Okay, I think you need to expect every ounce of a $150 move. And I'm going to say that again. I think you need to expect every ounce of a $150 move next week and then some. It is very rare that we do not touch the upper and or lower edge of an expected move. In fact, if you actually have this SPX expected move, okay, and this is hand-drawn expected moves that I did. I mean, literally, you can go back like years and years. I actually started doing this, okay, all the way back in 2017. Okay, you can go back to 2017. There's handfuls of times where we just didn't touch the upper or lower edge of the expected move. Okay, and there's even less times where like you do it in consecutive weeks. So anticipate there's going to be opportunities to hit the upper and or lower edge of the expected move, which is actually going to open up SPX butterfly opportunities for next week. But $150 expected move on the table for next week. Hopefully some volume, some liquidity actually comes back to this marketplace. I got to tell you, it is an eerie calm that has fallen over the marketplace. I remind each and every one of you, volatility is far from dead. Thanks everybody for joining us here at TheoTRADE. Have a wonderful holiday weekend. Bye-bye.